Let's get a better understanding of a QLAC and how it works. And I can't think of a better way to do it than to compare it to a deferred income annuity. So they both make an excellent retirement income planning tool, but the QLAC annuity actually has special features that a DIA cannot offer with respect to tax planning strategies. In this video, I'm going to show you how a QLAC is more powerful than a DIA in your retirement portfolio. By the end of this video, I'll give you the facts so that you can make an informed decision about whether a QLAC is the right fit for your retirement portfolio. Hi, my name is Darlene Hartman. I'm a CPA and founder of D. Hartman Consulting, LLC. For the best retirement annuity advice, subscribe to my YouTube channel and hit the notification bell so that you can receive notices anytime I post a new video. The first thing I want to do is show you the similarities between a QLAC contract and a deferred income annuity. So both are a fixed annuity, which means they're based off of a fixed interest rate. Now, given that we're in historically low interest rate environment, that means that neither of these products are a great growth product. Now, with respect to the deferral period, they both have a deferral period that is over a year. So that means you basically have to cook it at least 13 months. Now, with respect to a QLAC, that deferral period is between 15 years or up to the age of 85, whichever happens first. Whereas in a deferred income annuity, that deferral period can be anywhere from 13 months up to 45 years. They both are referred to as a longevity annuity if set up as such, which means you never will outlive your money for either of them. So if you're getting those guaranteed income paychecks until you die, you never have to worry about not getting your paycheck every month while you're alive. Also, with respect to both, you can put in a single lump sum payment or you can make flexible payments during the deferral period. With respect to those flexible payments, you also have the option for both a deferred income annuity and a QLAC contract that you can make additional deposits into the contract. So those are deposits that were not initially negotiated at the time you signed the contract, but they will provide you or enhance your guarantees so that when you get your income paychecks, they'll actually be more to reflect those additional deposits that you made during the deferral period. Leave me a comment in the section below and let me know if your retirement portfolio currently consists of a QLAC and a DIA. Also, if you're enjoying this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and hit the notification bell so that you can receive notices when I post new videos. As I mentioned in the previous video, you can only include a QLAC contract in a qualified account. And just to remind you of what a qualified account is typically your employer plans a 401k, a 403b, and a government 457b, and it can also be a traditional IRA. So you cannot include a QLAC in a Roth IRA or a taxable account. Now, with respect to a DIA, you can include it in a qualified or a non-qualified account. It doesn't matter. But what I want you to bear in mind is that the QLAC covers a period of up to 15 years or the age of 85, whichever comes first, whereas in a DIA, you can actually defer it for up to 45 years. But if you have your deferred income annuity in a qualified account, the IRS is going to come knocking on your door at the age of 72 to tell you that you've got to make these required minimum distributions starting at the age of 72. So even if your deferred income annuity is deferred past the age of 72, you still have to make those required minimum distributions at the age of 72. Whereas in the QLAC, if you can defer it all the way up to the age of 85, that means between the ages of 72 and 84, you don't have to make those required minimum distributions from the QLAC. That's what makes it such an incredible tax planning strategy tool for your retirement portfolio. Because if you don't need that money, number one, you don't have to take it out. Number two, if you're not taking the money out of your retirement portfolio, you're not having to pay taxes for it. But here's, let's call it the QLAC limitation or limit. So you are not able to put in more than $130,000 into a QLAC contract. So it specifically states the QLAC limit is no more than 25% of the total amount in your qualified accounts, or up to $130,000. Whereas in a deferred income annuity, you can put in as much as you want. There's no limits because they can go into a qualified or non-qualified. But don't forget, if you put that deferred income annuity in a qualified account, you will have to start taking required minimum distributions starting at the age of 72. So my advice is if you want to defer it past the age of 72, do not put a deferred income annuity in a qualified account. Now, both cover a single life and a joint life. And both would benefit from setting it up for a joint life. Just remember, your payments are going to be smaller if you cover a joint life, but it covers two lives. So you have to look at the bigger picture there. But a QLAC is a lot more beneficial because of the tax planning strategies to mitigate taxes early in retirement. I also want you to keep in mind with respect to a QLAC that if you have a spouse that has a qualified account, I highly encourage the spouse to obtain a QLAC also, because now you're doubling the benefit. Instead of it being up to $130,000 per individual, it can be up to $260,000 per household. Now, a QLAC is inflation adjusted so that the limit increases by $5,000 to $10,000 increments, whereas in a deferred income annuity, if you want that inflation protection, you have to purchase a rider to get that inflation protection. Now, the death benefit for a QLAC is more limited than the death benefit for a deferred income annuity. So I talked about those customizable payout options for a deferred income annuity in a previous video. And you have several options, including the option of not ensuring that you receive 100% principal protection, whereas it's actually built into the QLAC that you are guaranteed 100% principal protection. You know, as with any association with the government, any product associated with the government, you do have specific rules. But just to give you an example, if you pass before you start receiving those guaranteed income paychecks from your qualified longevity annuity contract, 100% of the principal will be returned to your beneficiary. Now you can see how the QLAC is a much more powerful fixed annuity than a DIA. Just those simple tax planning strategies to help you mitigate taxes in your retirement makes it more powerful than a DIA. If you feel like you cannot retire properly without the lifetime income guarantees that a QLAC can provide, and you're interested in those tax mitigating strategies that a QLAC can offer, be sure to click the link below to apply to become my client. Also, if you enjoyed this video, give me a thumbs up, subscribe to my YouTube channel, and hit the notification bell so that you can receive notices anytime I post a new video. Thank you for watching. Don't forget too to share with your friends and family. Let's get the conversation started on how you can live your best retirement while not outliving your money.